Guillaume, thanks very much for joining us. Good to see you. It would be interesting to get your take, I suppose, on MIPIM and what your sense was there of the overall view in the market.
I felt so much energy, so much positive energy on MIPIM, and that was really, reconforting. And I was really pleased to see a lot of professionals coming from all Europe and a little bit from the US and the rest of the world, gathering, sharing ideas. And, since the last 2 years, I would say we've been kind of skipping those kind of big events where multicultural people get into one place and share ideas and speak about business. So the first, I would say, kind of output from MIPIM is the positivity, the energy, and the willingness to do business. So that was, I would say, the three kind of main items that I would like to share with you. Obviously, there's still, we didn't change for the last years. So I would say the three top topics are obviously, residentials, sheds, and meds. But it was really interesting to see notably mostly the investors that, are more willing to get value of our real estate, trying to think back once again about retail, about hotel. Those two asset classes were kind of left kind of aside for the last 2-3 years for hotel, and obviously even more for retail. And I would say that value add and opportunistic money, has to go somewhere. So those guys are now looking at those kind of blacklisted assets, and it's really interesting to see how this capital is trying to penetrate, I would say, those kind of no-go zones, I would say, for the last 3 to 5 years. So it will be really interesting to understand how those asset classes are going to behave over the next couple of years. And I'm still, positively amazed by the capacity of, all the investors, all the partners within real estate to be so willing and to be so pushy around deals, because we all have TV, and when we put on the news, it's pretty scary. Inflation, still the virus around, obviously, all the bad things that are happening in the eastern side of Europe. So more money concentrating on the same kind of geography. So all of this, would have potentially shaken us, but it's like nothing can hurt us, and nothing can go, I would say, towards all that motivation and positive energy that is willing to do, I would say, business in the next at least couple years. Interesting thing also is, as per diversification, unfortunately, with what's happening, Central and Eastern Europe are really, really complex to go into from a pure investment perspective, not even talking about financing. So there's even more capital, as I was saying, coming into Western Europe. So we tend to see now a lot of capital going through the region. And it's really interesting because a lot of that capital for the last, I would say, 20 to 30 years were more, focusing on the top cities in Europe. And it's really interesting to see, I would say, the big firms or the big names of private equity in London trying to look at tier 2, even tier 3 cities in the middle of Germany, in the middle of France, even in Italy and in Spain. So I think Western Europe obviously will be the beneficiary from the global situation at the East and from an economic perspective. Potentially, all the close elections and the crazy politicians that are kind of scaring some of the investment strategy are going to push the capital away from one or two countries, but I don't expect so. But I'm really interested to see how the Western region are going to behave and how the pricing and the values are going to go up in the next months.
Again, you mentioned there, that positive sentiment and some of the risks, but do you think investors are underplaying the risks? I mean, especially when you look at, say, geopolitics, inflation, and of course those concerns that are still there over the COVID virus.
As of now, most of the investors have, research department of a lot of people, I would say, around the table monitoring the risk, and you have a lot of compliance around. So I think the investment as of now are much more safer than, what could have been done, I would say, before GFC or, in the early 2000s or even in the 90s, where basically it was mostly gut filling and rapid deployment of capital. So I would bear in mind that now I would say there's a lot of blockers before doing any investment, because that's a good thing. But obviously, when you look at the dark clouds that are kind of, dancing around our heads, at some point the music is going to stop. So I would say, financing has been really careful. Now the debt funds are coming, and, basically behind the debt fund, it's, don't fool ourselves, it's equity. So equity and equity behind the debt fund. So double equity is kind of getting into the situation. So I really hope that the equity behind the debt is not going to push too much the values. I think this is where we are to be, really careful in the next underwriting we do for mostly value-add or opportunistic situation. But as we see the world today and all the capital that's meant to be deployed, I would expect that if the money is still going to be spread over the Western Europe, I don't see major risk for midterm or long-term perspective. I would say the real critical kind of sense is more on the short term, where you want to make a quick turnaround. With all the situation, it could be more dangerous to figure out a 2-3 years, I would say, kind of strategy versus a midterm or long-term one.
Really interesting to catch up. Thanks very much for sharing your views, Guillaume.
Thank you very much, Richard. Speak soon.